day. Joining us now, Jeremy Nelson, partner at Element Wealth. Jeremy, always good to see you. Thanks for coming in.
Always a pleasure.
So we got some news this morning. We'll kind of kick off our financial discussion. We got the latest producer price index reading. Came in a bit hotter than expected.
Yeah, I mean, this is kind of one of the things that we continue to see is that across the board, we've hit a level now where, inflation is sticky, and we're starting to, we're seeing numbers that are just a little bit hotter and showing us that the inflation is here to stay at, slightly elevated levels from where the Fed really wants inflation to be at.
Yeah. And, the markets initially just kind of shrugged it off. I watched this morning, futures were up. They did pare down a little bit. Now they're in the red.
Yeah, I think the futures shrugged it off initially because you're seeing the 10-year Treasury backing off a little bit. Some of that's just, general demand. Once you saw the 10-year hit 4.8%, there was a little bit more demand for it. You had the Hamas attack with Israel there. So I think ultimately, the bid on the market was because rates were down a little bit.
Yeah.
And so, people moved a little into equities there. But now people are looking at it and going, wait, yeah, this inflation, it's sticky. It's not going away.
But we did have, I guess, a bit of an indicator. I believe it was yesterday when some of the Fed officials said, we may be done, suggesting with a pause at least or a termination of rate hikes. But I wonder if that was just in response to the geopolitical strife in the world.
I think there's an aspect of politicking there, right? The worst thing that could happen is that the markets turn into a mess and inflation is stubborn and you got geopolitical risk. That could create a real vacuum for stocks, which ultimately could be very negative for the economy. So I think that there's a little bit of politicking in there. Our view continues to be that rates are gonna hang up for longer.
Yeah.
Look, historically speaking, 5.25 Fed funds rate when you've got 3+% inflation, that's not crazy. That's pretty standard.
Yeah. It's in line. Yeah, I would agree with you. So explain to the audience, because I know you and I kind of get deep into this stuff, why the increase in the Fed funds rate, just interest rates in general, are not necessarily positive for equities, for stocks.
Well, so number one is it increases the risk-free rate. All right. And so if you think about a company, what's the value of a company? Well, it's in classic finance terms, what you learn in MBA school is it's the net present value of future cash flows. Right. And so you end up having to discount the future cash flows of a business more heavily, which means that in today's terms, the company is worth less.
Yeah. So just to kind of cut through that a little bit, all we're really talking about is just the financial performance, essentially, the cash generated by the company over a series of years, and you sort of bring that down to, well, what would that be worth today? Is the way we're doing that, and that's how is a typical formula used to just value companies, put a number on them.
And this is not a perfect analogy, but I think the simplest analogy that I use with clients a lot is, hey, today mortgage rates are 8%. They used to be 3%. Can you afford as much house today at the higher interest rate? No. Well, same thing goes. You can't afford as much future earnings, right? For a company.
Good point. Yeah. So we seem to have so much focus on this whole interest rate environment that seems to be top of investors' minds. And I only say that because it seems to me kind of taking a back seat to that are just technicals and fundamentals. How good is this company doing? Is it making money? Does it have a good strategy? Is it got a good positive future outlook?
Yeah, well, I think the reason it's in such focus today is, if you go back to, post-financial crisis, let's call it 2010 up through, 2021, the bull market, half of the gains in the S&P 500 approximately came from actual earnings growth. That's real, right? Companies are making more money, therefore they are worth more. The other half of it came from valuations going up, just paying more for the same stuff.
Yeah.
And that is what's eroding as interest rates go up right now.
Yeah, and something that I've been concerned about, honestly, is the amount of debt that's terming out, both in the private sector, corporate debt, where they've gone to the market and borrowed money. And then you've got banks who've got lots of U.S. Treasuries and sometimes corporate debt on their balance sheets. And then you got the federal government itself. I saw the other day that the average interest rate on our outstanding debt is about 2.6%.
Oh, and pushing much higher.
Yeah,
right?
and much of that's coming due. It's got to roll. We don't have the money to go pay it off.
Interest for the government, right? Interest costs as a percentage of the budget is going to go through the roof. And for companies, if you think about it, so I was looking at, and this is not a buy or sell recommendation on the company, but I was looking at Verizon, and they've got debt that's coming due that was at 0.65% or 1.5%. Well, now they're going to have to refinance that debt at 6%. So that interest cost increase is going to be a hit to that company's earnings, and that's going to happen across the board.
Yeah, so I'm looking at it right now. As of August, average monthly interest rate on U.S. debt, 2.92%. But trillions of the $33 trillion we have due are terming out over the next year, which have got to be refinanced, and they got to go out and sell it for 4% and 5%.
Yeah, because the Fed wasn't able to go lock all of their issuance in 30 years, right?
2%.
A lot of it was short term. There wasn't a demand for the 30-year. They had to issue it much shorter term.
Right.
Back in 2018, we did a presentation, and we showed that at the rate we were going, again, this is pre-COVID, at the rate we were going, interest cost as a percentage of the federal budget was like 8%.
Yep.
If the 10-year Treasury went to 4%, that in 8 to 10 years, we were going to go to 16%. So that's what's happening right now. That's why there's this debt issue, this deficit, this $2 trillion deficit that we're running is a major issue. It's kind of coming and smacking us in the face right now.
Yeah, and so just to put that in dollar value terms, our interest on our debt this year is going to come in just under $700 billion. And having to refinance a big portion of that, within 2 years, we'll hit the $1 trillion mark. So just for the benefit of the audience, you said up to what, 14, 15%? 16%.
16%, yeah.
Yeah. That's more than the military. So we'll be spending more on interest than we are the military.
Yeah, and so when you think about it, if you've got, 60+% that's going towards, Social Security, Medicare, Medicaid, right, the entitlement programs, you've got military, and then you've got more than the military going to interest costs, there's not a lot of money left over for everything else.
No doubt about it. And that's right where we are right now, and it's one of the reasons that the U.S. House is going to be casting a vote to elect a new speaker. They weren't happy with the way he handled that.
Yeah.
That's the core of it.
It is. This is not a new issue. This is something that's been going on for a long time. And I remember back just in the initial quantitative easing days, right, 2009, 10, and up through 2021, people would ask me, well, when is the debt gonna? Why does the debt not matter? I'm like, it does. It just doesn't matter till it matters. Until it smacks you in the face, and that's the point at which we're at right now.
Well, I think there's kind of a, I guess you could call it a misconception that someday we're going to have to pay all this off. I don't believe that day will ever come that we will actually pay it off. But how we pay for it is in the form of inflation.
Well, inflation, that's why the Fed wants at least some inflation, right? Because you can inflate it away in dollar terms
that's true.
Over time, right?
Because you borrowed it 10 years ago and you're paying it off now and it's worth a lot less.
I think the misconception that the average person has is that the government has to pay it off. The government doesn't have to pay it off.
That's right.
It's about the government's ability to service the debt, because the U.S. government is a perpetual entity. It's not like you or I where, hey, one day we're going to be in the ground And so we're going to have to settle up our debts at that point in time,
That's
right?
right, yeah.
The government will continue on. So what it's really about is the government being in a position to be able to service the debt.
We also can't apply quantitative easing to the management of our household finance.
Yeah, we can't just magically make money on our balance sheet. Yeah.
We got Jeremy Nelson from Element Wealth in the Element Wealth studio. We're visiting with Jeremy Nelson, partner at Element Wealth. And on the C Spire text line, Farm Bureau put out a report 10 years ago that said when we passed $33 trillion, that was a point of no return. Well, I guess I'd have to understand what they mean by no return. We're certainly not even remotely close to reducing the debt balance. I mean, the first thing you got to do is balance the budget. Do that. As long as you're producing deficits, you're going to add to the debt.
Yeah, I think the point of no return means that it fundamentally alters the budget of the government, and you have to address it at that point in time.
Yeah, well, that's true. And I think what bothers me, and something we talked about on the program, is we got the Fed that is using the tools at its disposal to rein in inflation, mainly interest rates, the Fed funds rate. But it's in direct competition with bad fiscal policy on the other side from an inflation perspective, because they're not reining in spending. As long as they spend more than they take in, we got inflation.
Yeah, look, I sat on a call a few years ago with former Chairman Ben Bernanke, and in polite words, he basically said, monetary policy can only bail out bad fiscal policy for so long, and we're at that point.
That's where we are now. Yeah,
I mean, the writing was on the wall years ago, and it's hitting us in the face right now.
No doubt. So for the folks, monetary policy, that refers to policies that come from the Federal Reserve. Fiscal policy, that's from the federal government. So and really the Federal Reserve, they got a couple of tools. Interest rates and what they call federal open market operations, right, where they go out and buy and sell bonds, essentially. So load up their balance sheet. Or right now they're unwinding that balance sheet. So they're liquidating bonds and not replacing them, best I can tell. That balance sheet's shrinking. They
are shrinking the balance sheet right now. That process started, a while ago. It's been happening all throughout, 2022. Now, when the banking crisis hit in February, March of this year, they had to kind of unwind that a little bit to ease it up on the banks.
Yeah.
But they're back to that balance sheet roll off.
Yeah, but Chairman Powell won't say anything about fiscal policy. He avoids that conversation. Anytime the reporters ask him after he comes out and gives comments after the open market meets.
Yeah, look, ultimately the Fed is not supposed to be it's supposed to be a non-political entity. So seldom, if ever, are you going to have the Federal Reserve speaking out against the government.
Yeah, and he won't do it, but some historically have been a little bit more brave than others, right?
Yes.
Like Bernanke was.
Bernanke made some comments. Greenspan was, a little more outspoken. Volcker for sure. But it's very – we're so polarized in the country right now that I think that it's wise that the Federal Reserve just stick to doing their job.
Yeah.
Let the voters sort it out.
So, I know that a lot of your clients are folks that have been accumulating money and through their working years, and they're retiring right now. So they've got a nest egg, and they want professional help to manage those assets and invest it wisely. And I know you sit down with folks and determine kind of what their goals are, what their needs are, and then you advise as well in that regard. Are you starting, and this is where I'm going with this, are you starting to see and hear about folks maybe delaying retirement a bit because of inflation, because maybe of the concern of the ability to generate income in retirement with their assets?
Well, so one, the ability to generate income has gone up, right? As interest rates have gone up.
Right,
so that's a better proposition, and we've talked about that on the show before. Yes, absolutely, you are seeing workers across the board. We see it more in our 401k consulting business. You are seeing workers who are planning to work longer because the inflation is hitting them harder.
Yeah. I think folks are, and they're seeing people living longer, which is a good thing. We're living longer, and medical science has certainly made that possible to a great extent, and they're thinking about, do I have enough money, to last me?
Yeah, and people are also looking at what can I do kind of as an encore career.
Okay.
Right? So I was meeting with a litigator today, and that's a taxing job. But he started thinking about, well, at some point I could just slow down and do mediation.
Yeah.
Or people are taking on part-time jobs doing things. Number one, it's great because it keeps you busy, but also puts a little bit of money in the checking account.
Yeah. So the combination of the retirement nest egg income plus maybe income that's not what they were accustomed to. Perhaps this individual is a litigator, but go do something else. It still supplements their income.
You don't have to necessarily make as much money and be saving, but if you can help offset some of your expenses with some income in retirement, that is becoming a very popular strategy. And look, there's a massive labor shortage, so the opportunities are out there for people to kind of choose what they want to do.
Yeah, there's no doubt. I probably not a day goes by I don't hear from just people I've known and met through the years across the country, honestly, say, hey, I got one this morning from a private equity group in California that said, hey, we're looking for a chief revenue officer and a chief marketing officer at a company that was similar to mine. You got anybody? It's a portfolio company that a private equity firm owns. You got anybody in mind? And of course, they don't tell you who it is and where they are, and I understand that. They're going to keep that confidential, but that's just an example.
Well, you're an example. You're a radio host now, right? I mean, you're hosting a radio show. That's
right.
A new thing. It wasn't necessarily on your roadmap. When
Never saw that coming. That's no doubt about that. What a juxtaposition that was from your hair on fire trying to run an IT business every day. Artificial intelligence is thought to be a shot in the arm, I think, of equities for sure. In NVIDIA, I saw somebody put a price target on that of doubling. It's crazy. It's like what, $350, $400 a share right now.
So what I look at is 37 times sales, and you're talking about doubling the price on that. That seems a little aggressive to me.
It does.
I think that people are scared of AI. Right?
Yeah.
We've all seen movies like Terminator and different things. So we have this idea that the robots are going to take over.
Yeah.
Right now, I think there are some real risks to AI, and you're even seeing the Zuckerbergs and the Elon Musks out there that are saying, hey, we've got to come up with some regulation around this. So I totally agree with that. But AI ultimately, and technology in general, is the first thing that we've had in a long time that can actually significantly increase labor productivity.
That's true.
And if you think about it over the long term, labor productivity is the backbone of economic growth.
Yeah,
because
of wealth creation.
Yeah, as a worker, if I can produce more, I will make more money. If I make more money, I will consume more. Consumption is 68% of the economy, so if I consume more, the economy grows. So AI is not something to completely fear. It is something that long term, from an economic perspective, is going to enable us to do more. It will eliminate jobs, but it will also create new jobs. And I use the computer as an example, right? The computer replaced a lot of jobs, but it also created a whole new industry and a ton more jobs.
Yeah, that's absolutely right. I totally agree. I'm on the same page with you there. And I heard, so I just heard some reports this morning, some analysts that are predicting NVIDIA to double. And what they're saying is that, all the folks that consume their chips, I mean, what they make, just are have all these very grand, extravagant plans for AI, and they need that hardware.
Yeah, I mean, the question there with just hopping on one company is you don't know what a Taiwan Semiconductor and AMD and Intel, there's a lot of different chips manufacturers out there over time the gap between an NVIDIA and them in that space will close.
That's right. And they won't have the dominant position and be and quite have the penetration of the market that they do today, the market share. I agree with you.
Yahoo once had all the search, right?
That's absolutely
right. And now
right.
Google does.
Yeah.
So you don't know what will happen. Again, that's why within a stock portfolio you diversify.
That's right. And it's you can hedge that position for sure. But this it could be, though, something that has a lot of legs, talking about AI specifically, much the way the build out of the internet did in the late 90s. I mean, that powered the markets and made a lot of people a lot of money.
Oh, absolutely. There's the opportunity there. I think that it will ultimately help profits and productivity across many sectors. I don't think you only need to be focused on the companies that are producing it.
I totally agree. There's a lot of other ways to participate in the AI boom. You're right, than just investing in companies that make the products.
Because those companies have to make more money in order to buy that.
That's absolutely right. Good point. Yeah. Jeremy, appreciate you coming in. Always enjoy it.
Always. Thank you.
Jeremy Nelson, partner at Element Wealth, has been our guest in the Element Wealth studio. We're coming right back.